Hi everyone, we'll just wait for a couple of more minutes. We start at 8:10 in IST, and this is strictly for non-resident Indians. So if you're a resident Indian and you still want some information, that's all right. But this is strictly for resident Indians. You can join in the Q&A if you're a resident Indian. Okay? Thank you. Thanks everybody for waiting up. I think we can start now. So yeah, so we did this. We keep doing beyond ESOPs every month. And why we're doing this is because yes, we do want to give out that knowledge of what to do with your ESOP. Get a good. You should be able to get a good amount of knowledge as to what you should be able to do with your ESOP. When do you invest it? And all of that. So the main thing for ESOPs is diversification. Even your 401ks is majorly diversification, and we'll dwell into all of it little by little. Right. So early bird gets the worm. So early believers in a company's success story are the ones who actually benefit the most over a long period of time. Right. That's true. Yes, the more you stick along the road, you're definitely going to benefit out of it. So let's look at an actual story. So this is a person who is at the tech company. He works at a tech company, started a tech company. After 10 years, he felt that he needed a new challenge. So he went to the US based, he went to Hyderabad and he started working in a US based tech company. And his compensation was that his salary was 10% lower than what he was drawing. He will be getting ESOPs, RSUs, and the year-end cash bonus will be 20% of his annual income. Right. He could also participate in the plan. Right. So his salary was low, plus he's getting ESOPs, plus he gets to participate in the plan. Right. So if he had a clear understanding of his deliverables, he could earn his 20% bonus, and the purchase plan was structured so that he could make an immediate 10% return on his investment. So this is fast return. Just keep that in mind. So this is quite fast. You make that 10%, and every year a portion of his RSU would vest, creating an additional stream of income. Right. So does this mean that this is a good chunk of his wealth creation? Right. So what happens is that his wealth creation is dependent entirely on how his company has performed. Yes, salary grows, company grows, salary will grow. Bonus, yes, at the end of the year. Now, when you get your RSU or ESOP, again, the stock price is what determines your, increments, right? And then there are your investments, right? So what do you need to know about RSUs, right? Only own RSUs on vesting. This reduces career mobility, right? Which means that, see, usually what happens is, usually in tech companies, what happens is you shift from one place to the other in hopes of, getting a good ESOP package because, they're doing very well. So if you look at Nvidia is doing pretty well. You heard many multi-millionaires already in Nvidia because they owned a lot of ESOPs, they owned a lot of RSUs, and now, they are already up for retirement, right? But you can't move, right? There's no guaranteed returns because there's concentration risk, right? You're parking more and more and more of your money into one egg. It's not going across the basket. It's just going into one. It's just going into the one thing. So the concentration risk, of course, rises. Now, you need some sort of concentration risk in wealth creation, but diversification is very important to protect you from drawdowns and protect you from any sort of volatility that comes in, right? So you can't not be a part of the volatile scenarios, but you can definitely protect yourself from again some sort of drawdown is definitely you can protect yourself by having multi sort of an approach, right? And it's taxed as income on vesting. That's the most important thing. We look at taxation, but it's taxed as income on vesting, right? Now ESOPs, all you need to know, it's an option to buy the stock. There are two levels of taxation. One is the slab, where it's fair value minus your excess price, so you're taxed there at slab rate, and then there is the capital gains tax, which means your selling minus cost is what you pay. So there are two levels of taxation for your ESOP. So when does the purchase plan make sense, right? The 10% gain only works if you sell immediately. If you want to hold it, it's not going to work, right? And there are better returns if you're at a cyclical low. Now, what a cyclical low means? Now, if you look at Intel, right? Intel, for example, is at decadal lows, right? It's one of the largest companies, semiconductor fab manufacturing countries in the world. It's at its cyclical low. It's at its low, right? It's at its decadal low. So here you have a chance of making more and more returns in the future for when things turn around, or if things turn around at all. Now, if you remember during the tech meltdown in 2020, 2021, after after Facebook had hit its peak and they were going through a lot of problems, uh, 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 at that price, it was that is Meta at that price was extremely juicy. It was trading at a single digit P, and we had also taken global calls from our side where we can take advantage of such juicy valuation. So yes, better returns at somewhat uh, cheaper valuation, and that can only come when it is at a cyclical low, right? So always remember that part, right? Accumulation and accumulation should happen. Yes, you should accumulate at good rates. Yes, you should dispose of when there is a peak that or there is overheating of market that sort of takes place. This is what making sense of ESPP cycle, right? So here, when you look at market cycles, there are phases of over optimism and there are phases of over pessimism, right? There too many people say buy, buy, buy. You're getting a lot of tips. You're getting when you read the newspaper, it's all bullish. When you go wherever they're reporting, everything seems to be good. Today, India is in a place where they say India is the only country that will offer you very high returns. It's not going to be China, no Korea, nothing. No other country can offer you India's sort of growth rate. And you're already seeing so many mid and small caps companies getting repriced. So naturally, everybody has become extremely confident that yes, we will be able to deliver. We will be able to deliver. And what that leads into is that you start paying in and start factoring in future growth today, right? So you start paying for that all of it today, thinking that it will all get executed as planned, right? So there is a bit of over optimism that comes in, and usually these are traits that we see during a peak. It can stay for a long time. The over optimism can go on for a long time, say 3 years or 4 years or so, but that's a period where you have to be cautious. So you should be willing to say dispose of at every level on top, right? Likewise, your participation level when there is fear needs to be very, very high. Needs to be very, very high. Investors that were able to take and employees that were able to take advantage of Meta during that $100, $120 sort of a phase where they were trading somewhere at 8, 9 times price to earning. Today, if you look at the stock price, it's almost 5x, right? Excluding dividends, almost 5x. So your participation levels when there is a cyclical low or when there is extreme pessimism in a business or a company should be much more higher. So then you can easily make very, very good returns. That way you are actually doing a good amount of risk management. At the same time, that concentration risk starts working for you, doesn't work against you. Concentration risk at a peak works against you. Concentration risk at when valuations are extremely low works for you. So always sort of remember that, right? But always is a cycle, so keep your eyes out to make a good decision, right? There will always be short-term divergence. So one thing that you should understand is from the inside view of a company, right? You will always feel that they're doing great work. You will always feel that they're doing great work and that there's no end at this level. So you might think that at these levels it's still trading very cheap and it's still going to cross, but that is your inside view. It's only one view and the market works completely different. So yes, there might be some sort of a short-term divergence, both from low to peak, peak to low. But in the long term, you might be right. In the long term, yes, it does reach its fair value. And having from an inside, it always looks like it's going to come very, very soon. Right? But that's not the case. That's far into the future, but that's not the case. Right? So always make sure that from the inside, there is a bias when you look at share prices. But from a long-term perspective, things do converge. So for example, employees at PayPal, right? Employees at PayPal at the peak during 2021 at $300 said that, and this was happening because we were working with these employees. Said that internally everybody is very bullish on fintech globally, right? But what happened to the fintech scenario after that is that there was no pricing power that came in, right? Apple Pay had just launched, and after that, you saw what happened to PayPal's stock price. Today, it had dropped all the way to $50, and then today it's somewhere around 70, 72, hovering around $70 or so. They had a CEO change, but from an inside, even at that price, things were looking extremely good, and people were participating. So today there is drastic wealth destruction for them, but ensure that yes, from an inside view it looks bullish, but from a long-term perspective, yes, they do converge over time, over a very long period of time, right? So stock prices are different, business fundamentals are different, right? The market has a brain of its own, so make sure that bias is something that you're very, very aware of, right? Now the tax impact. Now in RSU, during vesting, the market value of the shares at the time of vesting is considered as income and as taxed accordingly, right? So your short term is than 12 months, your tax at that level is 20%, and your long term is 12.5%, above gains of 1.25 lakhs, right? Likewise, global, it's at slab, and again the tax on long-term capital gains is the same. It's 12.5%, which is good. It used to be 20 with indexation benefit. They've taken off all that, and they've had one single rate, which is very good for everybody, right? And then in ESOP, during exercise, the difference between the fair value and the market value, the fair value and the exercise price is taxed at slab rate, but note that it is 24 months. So your long-term capital gains is all the same. Your short-term is your slab. The only difference is it's just one more year ahead. So 2 years is short-term, and long-term is short-term for 1 year for India, 2 years for global, right? So that's the tax impact. Now let's look at a case where we had reviewed an investor's ESOP, and if you see, they had approached us at the right time when things were not looking very good from a stock price perspective, but we can't name the company, but yes, this is the chart. Things were looking good from a fundamental perspective. It's just that the market was not willing to give it its fair share of valuation. So when the review happened, if you see here, there was a hold given. There was no need to panic sell. What happened after that was, over time, as things were progressing, at every level, we were able to take off some money and de-risk and channel that money towards other avenues where we can diversify. So we were taking off concentration risk and building into asset classes that were inherently very, very cheap, right? Now what happens is that, this is just a quote: all fortune is good fortune, for it rewards, disciplines, amends, and punishes, and so is either useful or just. But if you look at what majorly happens in the US, right, 64% of all 401k plan assets are invested in mutual funds, right? Out of that 64%, this is slightly dated, but this is data that we had taken from our 401k webinar as well, where me and Vinayak work on it. So I thought I'll just share one or two slides on it. 64% of 401k plans are invested in mutual funds, right? That's a very, very big number. That's a good number. It's almost $8 trillion worth of assets. Out of that 64%, 60% goes into equity mutual funds, right? So even when you look at your 401k plans that are there, right, all money is going into the same place over and over again, right? 60% of the mutual funds, to 30 into sort of hybrid, and the rest is going in debt, money market, and then there are some that goes into REIT. That's a very small portion, so there's no need for that, right? But 60% out of that 64 is going straight away into equity mutual funds. And where is it going within the equity mutual fund, right? It keeps on going into large caps, and within that large cap, it has an overweight and a concentration into the top 7 or 10 companies in the world, right? So all money is going to the same place. So even your 401k that looks to be a very diversified savings vehicle is not actually a diversified savings vehicle. because all money is going into the same place, right? So one component goes into your large caps, the other goes into, again, there is some developed plan that goes into plan for UK that they invest in, that is Europe. Then some money goes into emerging markets, that would be about 20% or so. That's very small, right? And then the rest has to go into money market, and then there's no allocation towards precious metals for any of the 401ks, and the rest goes into REITs, right? But that concept of a target dated fund is amazing, is excellent, right? Because they say that yes, you start today, you set your retirement date, let's say it's 2050, and rebalancing will take place automatically, right? So it's a fantastic concept. They take care of everything there. One drawback, and that is a major drawback, is it's not tailor made, right? They will automatically shift your money from equity to debt, regarding of what the market scenario is, regarding of what your scenario is, regarding of your goals. They would change it based on that particular time. So where they have about 12 years or so remaining, you will see a lot of rebalance start taking place. So, but main thing is it's not tailor made, right? It just happens automatically. It's an automatic rebalance without looking at the market scenario, without looking at anything. They just rebalance it, right? But we want a tailor-made scenario. We want a tailor-made sort of a solution for the investors that we work for their ESOP and their 401k plan, right? So that part of diversification is what we want to take over, right? So how should fortune favor our investor? Right. So you look at discipline, right? Strategic planning and asset allocation is what you need to look for, right? The main thing is concentration risk can work against you, for you. That depends on what the market scenario is. But what you need to look for is majorly asset allocation and plan. So always work with a particular plan, right? And that plan gives us that direction of how we need to channel that money and what the ultimate goal is, and then practice asset allocation. Now Neo is a product that does asset allocation. It's dynamic. It can go from 0 to 100 in equity, it can go from 0 to 100 in debt, it can go from 0 to 100 in precious metals. Within equity we can go global, we can do domestic, we can do via ETFs, we can do via sectors. In ETFs, we can do sectors. We can take a direct call. Likewise, on debt, we can take ETFs. Again, precious metals for us is via ETFs. So there is no cap on any asset class. So that's how we are looking at asset allocation, right? So goal-based asset mapping for strategic financial planning, prioritizing each goal. So we work based on that particular priority, take risk only based on particular priorities, and rebalance as and when the need for that particular goal arises, right? It's not based on any target date, but majorly it's a tailor-made solution. It's not automatic sort of rebalance. Everything as and when the goal nears is when we will start taking that call. Second, as and when market starts speaking out, we will take a valuation call at that point of time, right? So that discipline is what we require, is that yes, you can make monthly contributions to Neo, right? Neo is SEBI registered PMS, where the minimum ticket size is 50 lakhs. All of this will come later, but we've kept it extremely open-ended, like your mutual fund in India. We do take monthly contributions, and we sort of appreciate that yes, we do require that sort of monthly contribution, because everything is tailor-made, right? So somebody's requirement might be very high, so the work that goes on there will be extremely high, right? Main thing is that we invest at the right time and we invest at the right place, which means that there is a winner and there is a new winner and a new loser at every cycle, right? So here at the low, what happens is investors usually chase returns, right? And because you're seeing past returns, you usually chase the previous cycle's winner and not concentrate on the new cycle's new winner, right? So what we do is, since we are forward looking, we do identify what could be the winners based on fundamentals and valuation, and only then start taking a call, right? So for us, it's majorly investing at the right time and investing at the right place, right? So that's what we would take over, right? And this is a study from BHB where they say that it's 90% of determinants of portfolio return variability, right? So when you see why somebody else is doing better, why that portfolio is doing better, is because of asset allocation. It has nothing to do with what you're buying. It has nothing to do with when you're buying, right? It all has to do with how your current portfolio is structured from an asset allocation point of view, right? Are you overweight at the right on the right asset class at the right time? And that's what Neo does, right? So we are doing this, and we've been doing this in our domestic multi-asset fund called Sphere. So the same thing is happening here. It's dynamic. It can go from 0 to 100, right? So we are not overly committing ourselves to equity unless and until it's necessary, right? If you look at mutual funds in India, uh, and if you look at multi-asset allocation funds, they need to have a minimum of 10% in each of these asset classes, right? Or if you look at a hybrid, like an aggressive hybrid needs to have about 65% into equity, which we are not willing to commit. We do not need so much concentration risk unless and until it's required. Right? So we prefer to diversify across by not having a particular cap. Right now, multi-asset investing suits a wider range of risk profiles. Yes, usually that an aggressive investor will still be able to benefit of this. A conservative investor is definitely going to benefit of this, right? It exceeds because we are able to take advantage of all asset classes with lower volatility. Main thing is that it's low. It's the drawdowns are completely lower than that of 100% equity product. Right? That's the main thing. You're still able to make more or less the same returns as an 100% equity product would do, but you're doing this across asset classes where the risk is very well managed, right? So lower drawdowns is what you should actually be looking for. Stability and consistency is what you should be looking for when you partner with somebody who is managing multi-asset money, right? It exceeds the investor's return expectations, and it allows investors to participate continuously. Now, allows investors to participate continuously is basically that part that there's no commitment that you always have to go towards equity. This time in India, you are seeing opportunity arise on the debt side where the yields are somewhere between 7.3 7.5%, and India has recently got included in the global bond index, where already $25 billion worth of annual flows are coming in, which is very good, which means that yes, there is a good amount of liquidity on the debt market. So development of the debt market would take place very well, right? So there are opportunities that you can take advantage of in the Indian debt side. Second, we are at an interest rate peak here in India, so we don't know whether there is a cut in the US next month, but definitely when this cut does come, it's going to be beneficial for debt funds. Right. So naturally, that there is a good opportunity. So you don't only make you do make that sort of debt rally money as well. So your returns can go north of 8.2, 8.3% as well. So you make more money on the debt side, right? So it allows investors to participate continuously. Like, how can you make asset allocation work for you? Be conscious of valuations. We are very conscious of valuations. You don't like to overpay at all, right? We buy businesses that are market leaders. In a niche industry, they are monopolies. They are very large. Right, and there are a good amount of players in the particular industry. So they do have that core competitive advantages that actually benefit over the long period of that. Long-term convergence comes in only when all of this starts taking place, right? We are contrarian. The portfolio is going to be contrarian. We stay away from the crowd. It's more value-oriented. Value-oriented doesn't mean that we will only buy companies that are low PE. That's not how value investing works. It's majorly divergent in terms of its fundamental value and what the market is willing to pay for it. So we are contrarian in nature. We do stay away from the crowds, and we are majorly a buy and hold. Right. Our churn ratio is somewhere around 30% since inception. Our inception is 2022. So we are predominantly buy and hold, and we do go overweight. On right now, our overweight is also on the precious metal side. So we do go overweight, and a little bit of everything does work. Right. So we'll look at how that sort of little bit of everything has worked. So if you look at from inception, so when we compare ourselves to multi-asset mutual funds out there and flexi cap mutual funds out there, if you see from a 1, 3, 6, this is slightly dated. So if you see there has been good amount of activity that has since inception. 100% equity fund, more or less 100%, right? 93, 94 odd percent equity mutual fund that is more flexi cap oriented, where they would have large, mid, and smalls. There, we have been able to do slightly better than them as well by not having that much committed towards equity, right? So that shows you the strength of our portfolio, as to how we are able to capture returns by following contrarian investing, by following value investing, and by following multi-asset investing, right? So we do have precious metals in the basket. If you see our drawdowns in Neo since its inception, which is 17th October 2022, has been 4%. Multi-asset funds is 5%, and Nifty is 10. So we are falling much lower than the Nifty, and we're falling lower than multi-asset, the index as well, right? So the multi we are falling lower than the multi-asset index as well, and the Nifty 50 benchmark. So if you look at it from a performance perspective, this is June data. 78% of our money is in equity, 13% it is in precious metals. So you do see that there is an overweight on the precious metal side. Since inception, we have done very well. What you should notice is, and what you should understand is that uh, all portfolios are built very, very differently, which means that if there is an opportunity today, we start buying those businesses and we start buying those asset classes only then, right? So somebody who came in 6 months back would not have the same portfolio as you, right? Opportunities were different then, opportunities are different now. So you will see, but over a long period of time, yes, we would want to have the same businesses, but we would not be able to buy much of it, or we might be able to buy much more of it given the opportunity at that point in time. So it's not a model portfolio. Again, even there, it's tailor-made, and we do not buy everything on day one. Say, for example, if you do come with us today about the day one deployment is somewhere around 37-40%, which means that only that much of money is going out there. Right? The rest is in cash equivalents, where it's staggered approach in and staggered approach out. So we do not buy completely immediately. We do not sell completely. We like we said, when you saw the review, it's step up, and step up. So that's what we are looking to do. Right. So the minimum investment is 50 lakh INR. Our benchmark is the multi-asset index. The fees are fixed. It's 1.5% per annum, and this is computed on daily average portfolio value, and it is charged on a quarterly basis. We do want to work with investors who have a moderate risk appetite, where their horizon is a minimum of 5 to 7 years. So we can go 0 to 100 in anything. We don't have a cap on any asset class or any category, right? If you look at our entire team, Neo is headed by Sham sir. He is the CIO and the fund manager. And if you look at our team, we have our head of research, who is the fund manager, co-fund manager of True Blue, which is our large cap portfolio, which is Balaji sir. Rohit and Rajat, they are co-fund managers of our small cap portfolio, Vriddhi. And you have Niranjan sir, who is co-fund manager of Sphere and Neo as well. Right. So he is the head of investment strategy, and that part of multi-asset, both domestic and global, that is resident and non-resident Indian, comes onto investment strategy, right? So that's where I'm at. And if you look at the research and strategy team, it's a fairly big team. Our sales team again is somewhere about 23 people. So whatever decision we take is based purely on fundamental research, and position sizing also is completely taken care of given market conditions, given whatever opportunity is there. Right. So now I'll open the floor for Q&A. So there's a question of, do you invest in USD? No, we invest in INR. Mm. So we invest in global equities via ETFs. Right now, the option for us to buy direct stocks is not there yet. It's still developing. Gift City is still developing, but we are reviewing 401ks globally for our US clients, and Vinayak also does that. Vinayak, I think he's already on the call. So so we do have a good amount of work and research that we've done on the US side that feeds us here on. So it's a good synergy for us where we do invest via ETFs. And that's not only on the US. We do take Asia calls. We do take commodity calls. We do take other calls as well. It's not just pure, pure vanilla ETFs that we or fund of funds that we're able to invest in. Thank you so much for your time. Thank you. So I'll put in the number, and if any of you are interested, you want more information, you want more work to be done, just send us your feedback, just send us a hi, and with your requirement, and we'll definitely make sure to work on it. So if there are more, the floor is open. So if there are any further questions, I'm very happy to take it. We'll keep it open for another 3-4 minutes, no problem. Okay, do you guys send us an email on your thought basis while initiating new positions? See, what we do is from our side, you will have regular such events like these webinars. We do have sectoral events, but we do share quarterly letters that where our thoughts would be penned down, and that would come to you every quarter. So we do share letters, and that would have our why we're doing things in a particular, what we're thinking on the market, and why we're doing things in a particular manner. All the risk disclosure will come, what we're thinking of global risk, all of that would come up. So not while every time we do something new, but quarterly we will share uh, investor letters. Sure, we can have a one-on-one. Just send us a hi. Somebody from the team will definitely get in touch with you. We can have a one-on-one discussion, no problem at all. Okay, done. Thank you so much for your time. Have a great weekend ahead. Thank you.